So in the last quarter of 2017, markets finished on a real high. They rallied about 6% in US dollars over the last 12 weeks, which took total year gains to over 23% in US dollars. For Aussie investors, returns weren't quite as good because the Aussie dollar rallied a lot. But still, nonetheless, the year finished up 15%. So it was a really good quarter. So 2017, when we look back on it and trying to figure out what were going to be the best drivers of that performance, it was all about global GDP growth. When we started the year, we thought it'd be good GDP growth, but little did we expect just how well it would pan out across the year. It wasn't quite the Trump bump that people thought it would be. But what it meant was as global GDP accelerated, earnings per share grows, because what happens through time is GDP is a good lead indicator for earnings. But then on top of that, the icing on the cake of that was bond yields didn't rise. So traditionally when GDP goes up, bond yields tend to rise as well, which dampens some of the equity performance. So it was a perfect year for equity investors. Now at the fund level, some of the better performing stocks, I just nominate two here. One of them is a company called Open House. It's a Japanese condo developer and property developer. We've spoken about it before to our investors. It rallied 75% over the last 6 months and 40% over the last 3 months. Why? They came out with an amazing set of results. We thought they would do well. Turned out they did even better than what we thought they would. And the market, we think, is coming to appreciate what we thought was a really good business. Another stock that did really well was a company called Investors Cloud. We've been on Livewire and talked about that before. We've also presented to our investors on it. Investors Cloud, you could think of as the purple bricks of Japan. So they're going in there and they're creating a direct-to-market way of raising money for property stocks. The market loved their results, and we think as they've grown and that, people have come to understand the story better as well. And that was our second best performer over the last quarter. Yes, on the negative side, one of the larger detractors was a company called Alstom. If you live in Sydney or in Melbourne, you'll probably have been on one of their trains. Alstom had a really good period beforehand. By way of background, Alstom is having a merger with Siemens, another large train manufacturer. And the market thinks there's some great synergies to come out of this. But what happened over the last 12 weeks, the last quarter, was markets sort of became a little bit more concerned that the merger may not go through on the terms and some of the unions might vote against it. So what's our current view on Alstom? We continue to hold it. The unions, one union in particular in France, has come out against the merger. Now, we think this is quite rational. At the end of the day, which turkey votes for Christmas? And what we mean by that is if you're a union, you're not going to vote to actually have all your jobs laid off. So you're going to vote no, and you're going to try and entice the company to actually offer you sweeteners, i.e. larger layoff terms, less staff laid off, etc. And we think they'll come to a conclusion, but it's just part of the process. So in 2018, some of the risks and opportunities is firstly, we write a really long piece for our investors. So anything we say here, you can also go and read on our website in one of our larger pieces there, our half-yearly report. Some of the risks. Too much of a good thing. So we just talked a little bit before about how earnings did really well because GDP did well last year. Now, there is a risk though that if GDP keeps going up really fast, that all the central banks of the world have to tighten a lot more than what people first thought they would. And generally, bond yields rising is not a great backdrop for equities. Now, it doesn't mean equities go down on average, because as earnings tend to go up, it helps the equities rise. But if bond yields go up a lot, 1994 is the classic example. We had really strong GDP numbers come through. You had a bond rout. Now, that wasn't the end of the bond bull market either, but it did mean that equities suffered quite a strong headwind, in particular emerging markets. So that for us is the biggest risk, too much of a good thing. So on the other side, some of the opportunities. So remember we talked about, again, strong GDP, strong growth. There are certain regions of the world that do really well out of these sort of environments. Japan and Europe are two regions of the world where they're predominantly exporters. So all the countries there predominantly sell things to outside their region, which is different to somewhere like the US, which is more of an import-driven economy. So those regions tend to do well. The other area is emerging markets. 5 years ago, they were the darling of the markets. 2 years ago, they were hated, and now they're back more in the middle. So emerging markets should do okay, but again, be a little bit careful about bond yields. If they back up too fast, it's going to be hard for emerging markets to rally in that environment. At a sector level, if we move down from country or region, some of the areas that do well at the sectors are things like banks. Banks are traditionally late cycle. So if you think of Europe, you've got bond yields rising, which is good for banks because they can lend their money out at a better interest rate. And also there's more demand for credit. So as GDP grows, companies need to borrow more money to invest in their infrastructure, etc., and things like that. So banks tend to do quite well. So we like banks outside of Australia. These sort of late cyclicals tend to do okay. Commodities tend to do quite well. So there's some of the regions/sectors that we're looking at.